groups. So our investment methodology at Rally starts off with impact. So a lot of what's happening in the marketplace really starts off with return driven. There's an ESG lens, and ESG is really a risk assessment tool. It's still, my goal is to maximize returns, but I'm looking at ESG from what's the risk inherent in the delivery of those returns. When we think about impact, the way we look at it is we actually screen companies. Our methodology, we start off with the 17 Sustainable Development Goals. We break that down to 5 investable themes. Within those themes, we look for best in class that deliver against that theme, which then align to the Sustainable Development Goal. Key difference then is, sorry, I should just add, and then we do fundamental financial or quantitative analysis to make sure those companies are best in class. But the key difference for us is we're starting off with screening for impact first, not adding impact as an addition, as an add-on after we've decided. And so there is, and you may be thinking about, there is definitely in funds out there or companies or organizations or portfolio managers that talk about being, very strongly ESG driven or having an ESG lens or impact. Often what you'll see if you break that down, it's we've done the financial analysis. We think they'll deliver a good return. Now, what can I look for that allows me to call this an ESG related investment? If you ask questions about where does the financial team sit relative to the ESG team, often you find ESG sits in marketing because we need to tell a good story to our investors that we're ESG focused. The quantitative team sits somewhere else. You ask about who makes the decisions. So it's the quantitative or the financial team. The ESG team can provide input or recommendations, but the quantitative team doesn't have to listen to them. And you look at the reporting back from some portfolio managers that are strongly ESG driven, and it is relatively, I would call it relatively rudimentary, non-specific, and superficial, right? So we're trying to avoid that by saying if we start off with impact first and then still do fundamental due diligence, then in fact we can be assured that this screen of companies already gets us into impact world even before doing the financial world, and then we do the same level or more diligence on those companies to identify those companies that actually meet that financial criteria, having passed through our impact assessment criteria. So that's how we run ours. That's primarily for public equities. And then in the private sphere, again, we are looking at investing in fund managers. So we're looking at the funds, the performance of the companies, but also having that one-to-one relationship with the fund managers to assess whether impact is real or is it fictional, or is it superficial, or is it an add-on after the fact. Given that we've been in the private space for 10 years, we've got a really good handle and ability to see track record over 10 years as to who's real and who's actually doing this and adding a layer of impact at the end. I'm just going to give you one example of how that dispersion happens. And I won't name in this specific case, but there is a fund out there with a global, well-recognized mandate that it came to us and said, we want your investors, Rally, to put money into our global impact fund. And so we asked the question, well, tell me a little bit about what defines impact for this fund, because you've got a lot of non-impact funds out there. Why would a deal go into this specific fund? There was a pause, and then they said, size of investment. We said, just wait. So you're saying that if a deal's too small to fit into your regular for-profit fund, then you move it into the impact fund and call it an impact deal. And when you look at their assessment of impact, and I'm being a little bit facetious here, it was something like, yeah, the CEO once went to a food bank and can spell the word impact, and therefore it's an impact investment. I'm being a little bit facetious, but it was such a superficial after the fact layer to call this an impact fund to do what? To attract new capital that was under the guise of impact, but frankly had nothing to do with impact whatsoever. So there are funds out there, and then there are other vehicles out there where if you listen and talk to the manager, it's in their DNA. They live, they breathe it, they focus on stories about whose lives do we change, and capital is the way to do it. It's not the goal and the end game. You can look at structures. If I structure something that says, my success measure is my return, and I get a performance fee based on how much I deliver returns. But in an impact fund, does that make sense that I would be financially driven? So there's a whole bunch of, I'm going to say, contradictions or anomalies or whatever between those that are really delivering impact and those that aren't. And our goal at Rally is to be really authentic, rigorous, disciplined about how we do it.